Factor in the fact that the central banks have been using the Western suppression against us by accumulating more gold than at any time ever in the history of central banking over the last 2 years. At some point, gold needs to accurately reflect the massive central bank buying, the huge amount of inflation in the system. They'll try to paper it over and kick the can down the road. But at some point, the realization by the rest of the world is, we don't want your money anymore. We don't want your debt anymore. And I think that's one of the reasons you've seen gold go up in the face of rising interest rates. He's not doing anything like Volcker did. Volcker raised interest rates to 18.75%. Problem is, that's how you blow everything up.
In today's episode, Andy Schectman discusses the recent basis trade that major banks and institutions are taking, which consists on an arbitrage between the cash bonds and the futures to earn a riskless profit. Andy links this trade with the bull market in gold and silver as precious metals sets the stage to be sound money in 2024. In today's trading session, silver has rallied a bit, but it looks like the 200-day exponential moving average is offering a little bit of resistance. At this point, we are near an area that I think could offer a little bit of a short-term floor, this being the 2250 level, but I think that's more of a range or a zone that drops down to the $22 level. Hit the like button, smash the subscribe button, and turn on notifications so you do not miss out on our daily videos with arguably the most sought after commodities experts in YouTube. Also check our pinned comment if you're thinking about adding Bitcoin to your commodities portfolio to get the best bonuses available while supporting our channel. Enjoy the video.
Factor in the fact that the central banks have been using the Western suppression against us by accumulating more gold than at any time ever in the history of central banking over the last 2 years. At some point, gold needs to accurately reflect the massive central bank buying, the huge amount of inflation in the system, the epic monetary expansion that we've seen, and now the Fed moving away from rising real interest rates. And so, no, the only way that they would stop it would be to do what Volcker did. And it's ironic that our current Fed chief says he emulates the workings of Volcker, but really he isn't. He's not doing anything like Volcker did. Volcker raised interest rates to 18.75%. That's how you stop everything. But problem is, that's how you blow everything up too. And the situation in the United States is vastly different today than it was in 1980. And you don't have the ability to raise rates that high without destroying everything. And that's kind of brings us back to what we were saying earlier. I mean, at 4 or 5% rates, you start to see the second, third, and fourth largest bank failures in the history of this country, amongst others. You start to see banks wobbling. You start to see the whole system teetering. So they back off of that because they realize they got a little too aggressive there, trying to put the genie of inflation back in the bottle. And then they realize there is no way out of this. That's the truth. And so either they do that moment where they say, screw it, and jack rates way up and blow up the whole system, or they acquiesce. There's no middle ground. So no, I mean, and that's the micro versus the macro perspective. That's why these gyrations. And when I say, think about that for a minute, think of all the volatility we've seen since 2020, 1773 average, 1798 in 2021, 1801 in 2022, and 1943 in 2023. It is the tortoise. It is not the hare, but it is moving and it is keeping pace and it is performing as it's supposed to without anyone noticing. Last week or the week before, we have gold at all-time highs on the LBMA and on GLD, and there ain't a damn person talking about it.
Andy highlights one key factor to monitor is the 10-year yield in the United States, which serves as a barometer for general interest rate trends, thereby influencing precious metals. Lower interest rates traditionally boost the value of precious metals. However, silver stands out due to its industrial applications, making it susceptible to the ebb and flow of industrial demand. Any industrial slowdown could impact silver's demand. While the market is noisy and and multifaceted. Longer-term charts reveal a trading range between 22 and 26, hinting at a potential bounce. Patience is advised to fully capitalize on this consistent pattern. According to the Silver Institute, 2024 is expected to witness record-setting industrial demand for silver driven by investments in photovoltaics, power grids, 5G networks, consumer electronics, and increased vehicle production. This surge in industrial demand is not yet factored into silver's current pricing. However, this boost in industrial demand will be counterbalanced by reduced physical investment demand. Silver coin and bar demand are projected to decline by 21%, primarily due to decreased silver investments in India and Germany. This reduction is despite strong investment sentiment in North America. Investment in paper silver also fell in 2023, with record outflows from exchange traded funds, ETFs, for the second year in a row. Global jewelry demand is expected to rise slightly, excluding India, where a decline is forecasted after a record year in 2022. Silverware demand is anticipated to decrease by as much as 12% worldwide. The Silver Institute notes that total demand remains historically high, reaching the second highest level in history. Now, we'll show you more clips of the latest interview of Andy Schectman discussing this situation. But first, subscribe and turn on notifications to keep us motivated to do more videos. Thanks for your support. Enjoy the video.
The video is, Chris, is that no, I don't think there's anything they can do to stop this, because this is a lot more than what happens here in North America. In fact, it's what's happening around the globe. And I think around the globe, these people view gold and silver as money. And that's why you're seeing different prices on the Shanghai Gold Exchange. That's why you're seeing deliveries out of the ETFs or exchange for physical or price be damned, and just massive central bank acquisition. So whatever they do on this micro basis, sure, that's why, I would say micro is emotional, macro is logical. You look at things from a micro perspective, you're missing the whole boat. You get all tripped out and emotional and freaked out and make the wrong decisions. Take a step back and ask yourself, the Congressional Budget Office says in 7 years, every single penny of income tax goes just to pay the interest on the debt and mandatory entitlement spendings. That doesn't even take into account the costs of all these new immigrants, illegal immigrants, and who's going to pay for them. And, at that, ask yourself, how do we remain the world dominant military and financial superpower when every single penny of discretionary spending, including military, has to be borrowed? And the answer is you can't. So the macro perspective is, yeah, it may have an impact today or tomorrow or next month or whatever, but ask yourself how this all plays out in a few years. And, 7 years is probably more like 4 or 5 years. I don't know, but I certainly don't envy the Fed chair or the Treasury Secretary's job right now, because in both cases, I don't see a way out of this without ultimately paying the piper. And we should have paid the piper in 08, and we didn't, and we papered it over. So they'll do what they've always done. They'll try to paper it over and kick the can down the road. But at some point, the realization by the rest of the world is, we don't want your money anymore. We don't want your debt anymore. And I think that's one of the reasons you've seen gold go up in the face of rising interest rates, and Treasury yields are, we're watching the world, I think, have a good portion of the world who has been our creditors say, I think you don't have to hold treasuries with your surplus. You can buy real commodities. And I think gold, what it's done since 2020 is a good example of that. No one, if you asked a money manager, would it have been over the last 4 years a good way to safeguard your money in gold? And most people wouldn't even have a foggy idea on that. But from 1773 to 1943, in the last 4 years, it's making steady, solid gains. And I think that's the point here, is that from a historical perspective, Treasury bonds do not have a long history of being considered an asset. And I think the world is reevaluating it. And we've talked about how for the first time in 45 years, the 10-year treasury is more volatile than gold. Silver will have its day. Silver will slingshot. Silver is just as important from a monetary perspective in my mind as gold, but it is less recognized. It is more manipulated. It has a larger concentrated short position, but it has far more utilities and uses. It is strategic. It is far more strategic to me than it is industrial. And I think the old adage that you can only manipulate a market for an extended period of time is to push it in the direction that it is going. And for a long time, no one wanted these things. They just wanted treasuries and dollars and US-based real estate and securities and whatnot. And I think those times are changing. I truly, truly do. And so, no, I don't think there's anything they can do that can derail this, but certainly they can, knock it back a couple of steps and make people question what they're doing. And should I really be doing this? They're good at it. But ultimately, no, I don't see there's anything they can do that will have any real substantive effect on where gold and silver will end up at the end of the year.
What do you think of the basis trade? Will this speculative move by banks be the ultimate catalyst for a major bull run in gold and silver prices? Will the dollar survive? Post in the comments section your honest opinion on the matter, as it is very important for us to know what you're thinking. Thanks for watching the video to the end. Hope you'd enjoyed it, and I see you on the next one.